как понять, что это
Вы что-то будете показывать? Сейчас.
Конечно.
Просто вот тут есть такая кнопка демонстрации экрана.
Где?
Вот она зелененькая.
Про Zoom мне можете не рассказывать. Zoom я уже хорошо знаком.
Ну все. Здесь вот звук. Вот он идет. Вот вы сейчас говорите, видно, что он работает.
Здравствуйте, всем не слышно?
Тут просто никого нету. Похоже. Вот участник один.
А вы можете подключиться сейчас? У вас есть возможность?
Да. Так, это по той же ссылке, которая на 11:30, правильно?
Да.
На 11:30? Вот
да, да. Если вдруг тут что-то не так, вот можно будет просто попробовать поменять микрофон, если вдруг пропадет звук.
Смотрите, а вот этот единственный, или вот если я сяду, здесь оно тоже работает? Здесь микрофон потребляет звук? Выдает его туда? Здравствуйте.
Да, потребляет, но это мы сейчас учились вот от этих коробочек, не с компьютера.
Сейчас. Вы мьют нажмите, пожалуйста, у нас тогда не будет этого цикла. А я сейчас скажу.
Я лучше в коридор выйду.
Ну, давайте попробуем, действительно. Раз уж здесь.
Но можете тут в кондиционер где-то есть. Не надо?
Нет. Так, ну раз, прием. Все ли хорошо слышно?
Да, все слышно.
Отлично. Все, Максим, спасибо большое.
Если что, если вдруг батарейки закончатся, вот здесь вот вы видите, вот такая штучка вот. Может пропасть звук, но я их зарядила, если что, я вам поменяю.
Да, ну, я думаю, все будет хорошо.
Что, подойдите.
Отлично, спасибо большое. Так, все, с пропуском я так понял.
Ну, да, пока ходите.
Суть не меняется, надо приходить по электронному, да?
Нет.
Я имею в виду только по электронному. Я зайти внутрь смогу.
Вот через него.
Если я вам сейчас его отдам.
Не надо, я вам отдаю.
Забираешь с собой?
Да, пока вы читаете.
Все, до июня, до конца.
Да,
отлично.
все.
Тогда
ребята пишут, что кто-то опаздывает, просят подождать, может быть, там...
Давайте, я сейчас пока все проверю, все поставлю тут. Отлично. Так всегда, но никто вовремя никогда не приходит. Сколько уже... Я прошу... ну там ладно, ребята придут, извините, перед всеми. Так, а где флешку куда вставлять? Все, что ли? Хьюстон, у нас проблема. Я сейчас подойду, хорошо? Некуда вставить флешку. Ну, я понял, я сейчас что-нибудь отключу.
Вы пока тогда выберете мышку. Я им скажу, что третий нужен так.
Я правильно понимаю, мы, если убираем трансляцию, нам показывает доску, соответственно, камера где-то здесь, да?
Вот она камера.
Так близко.
Вы можете параллельно включить, и доска будет, и экранчик.
На реверснутых, да, чтобы коллегам правильно показывать.
Ну, вы можете, вот так можно ее еще, вот так вот еще ее можно вот поделать, вот так.
Понял.
Если вам...
Делает все хорошо, ничего не сломалось.
Да,
так, смотрите, сейчас, подождите. Это как, я понял, вот как задним ходом на машине с прицепом.
Да.
Примерно так. А здесь лучше будет?
Можете подвинуть.
Ну, по крайней
чуть-чуть
мере,
наклонить, наверное, надо.
сейчас
да?
сделаем. Я к тому, что... Так. Сейчас.
Сейчас сделаем, да, как лучше. Я просто пытаюсь, чтобы...
Все было видно. Неужели что-то надо будет настраивать?
Да.
А серьезно, что ли? То есть, не, она должна включиться.
Ну,
Подождите,
всё, да,
она
да,
сейчас
да.
так работает обычно.
У нас видео выключено.
А как? Мы же, я просто выключил гнездо, включил.
Ну, вот сейчас, видите.
Вот, видите. А вы что нажали?
Перечеркнута была камера.
Так, ну вот она. Фокус автомат, отлично.
Ну да, так получше.
Вот, мне кажется, вот все-таки ее всю видно будет.
Мгм.
Да, потому что, ну, на кусочки писать тяжело, а так, если что. Обычно вопрос.
Мгм.
Раньше были старые времена, вот здесь все показано.
Да, я уже не помню, когда были такие времена.
Довернуться скоро. Годика 2, я думаю, все.
Так, значит, если флешку пока, давайте так вот, мышку выверните. Представьте, потом не перекачайте, потом обратно.
Все у нас записывается, да, все наши вот эти с вами попытки сейчас все сделать.
Да. Можно было убрать.
Sergey, can you hear us? Please answer. Not that much. Чё? Можно один вопрос задам, потом там, окей. Почему намного привычнее вам в чате, нежели вот аудиально? Мне просто понять, как, может быть, коммуникацию по-другому построить.
Наверное, народ стесняется на своего голоса, если нас так не сказать.
Зачем? Так шансов мало пообщаться, в основном все переписываются. Окей. Okay, guys, let's proceed. Click here. This should be the one. Не помните? This one or
Даже переключали, может быть, его вынули.
Okay. Just a moment. We'll ask how to. Oh my God. Okay, let's start without that. Okay, guys. Today we have a seminar, and we will be calculating carried interest and some management fee. So actually, performance metrics of the funds is the topic of today's seminar. So just for you to remind, what is lifetime fees? Usually, when you are investing in a venture fund, throughout usually 10 plus years, you have to pay every year some amount of money, called management fee. It's fixed at 2% during the investment period, and slightly less after that. We will calculate that today. So from your commitment, if management fee is part of the commitment, the remaining capital only can be used for investments themselves, right? Sometimes management fee goes on top on commitment. So you should keep in mind that you will be paying potentially more than you legally obliged in the paper. Again, one of the pages from previous presentation, let's say we have a fund of size 100 million, it has standard terms, half of the period is investment period, management fee 2% per annum, and its whole fund basis waterfall. So first we have to get 100% of our cost as investors, and then we will split the performance, so the actually positive return if the fund does have it. That's just, I will show you some calculations just for you to remind. If management fee is part of the commitment, so lifetime fees will be 2% multiplied by the commitment multiplied by the term of the fund, so 10 years. So actually from 100 million, 20 will be just your sunk cost, and they will not be participating, and it's not will be the base for investment returns. The remaining part is the capital which will be invested, and potentially which will provide you some increase in capital. If management fee is not a part of the commitment, so you take this amount and put it on top. So total capital called during the lifetime of the fund might reach 120, potentially. Usually, general partner doesn't get the 100% of the commitment. Still, in the latter years, that's not the case. Usually, they take even more. Management fee usually changes after the investment period from commitment capital to net invested capital. Remember, net invested capital is just only a fraction of commitment that it decreases with time because you get rid of the investments in the portfolio. Again, carried interest. That's the share of the manager in the profits. No profits, no performance, no bonuses. It's paid on cash basis, so the profits should be realized. Mark to market on paper doesn't count. Usually it's 20% after the cost, so expenses, management fee, and investment cost. There is a catch-up provision if there is a hurdle rate. So hurdle rate actually is just the mechanism which makes the sequencing of the profit. If the profit is huge enough, there is actually no difference between the waterfall with hurdle and without that one. It might be subject to escrow account, but that's a legal issue, just not something we should focus on. Again, usually two forms, whole fund basis, which is called usually European style, and deal by deal basis, US style. So in this case, carried interest is being paid only after limited partners, i.e. investors, have received their cost basis. In these situations, it's not the case. Manager starts getting profits after each successful deal. This picture should remind you how it works. So we have invested capital total, so costs, investment costs, management fee, other expenses, and potential profits. And we should somehow split that. So first and second, which cost and hurdle rate goes to limited partner. Then the catch-up portion goes to general partner, and if something remains, it is being split. Sorry for a moment, it's becoming hot now. So basic case, this one, with hurdle, we have several steps in between. Just for you to remind, we will be calculating today these things and some other things as well. So just again, example, simple one, just one investment. The fund called down 100 million at start of year one. We have management fee 2%, which is 2 million per year. And in 3 years, we have realized some profits. And we should calculate distributions and point out what the carried interest is for general partner. In this case, it's easy. So first we take costs of the limited partners. It's the cost, investment cost, and 3 years of management fee, right? Year one, year two, year three. Each year for 2 million, so 106. And we split the remaining thing. That's the basic structure. That's clear? Okay. Now let's take the hurdle rate as a part of the equation. We have general GP catch-up and the same situation. Again, first cost to limited partner. Then we have to calculate this so-called preferred return. It's just simple IRR terms. You take the cash flows and you calculate this, like, consider that as a deposit where you put your capital calls. And don't forget to minus the base. This was not done last time. So this is the second part, which should firstly go to investors. Then the general partner should get each dollar before he has 20% of the profits. So actually the previous one should be 80%. Then general partner takes next 20%. So altogether they are 100. And this is the point when it stops, and then it just continues to split. And the remaining part is being split. Mathematically, you will get that once you will do a couple of exercises. The idea, I hope it's clear. Okay. Now, let's talk about evaluating fund performance. Remember, there are several multiples which should be taken into account when you compare different funds among themselves. So first one is paid in capital. That's capital paid divided by commitment. DPI, which is distributed to paid in. So actually it shows you what part of the paid in capital has been returned already to you on a cash basis, for sure. And there's one caveat. You should consider net distributions to you, right? So if there was a deal by deal basis, carried interest taken. So actually you take the net part. So if general partner takes something to himself, you consider in this calculation only the part which goes to you. And the residual value TPID, that's something which is still on the fund, and you divide it by the operating capital. So the total TVPI multiple is just the sum of DPI and RDPI. Again, net of fees and interest. The task from the last presentation, just for you to get the answers. Again, we invested 150, the total fund size is 200, so this is how we should calculate paid capital. So 75% of obligation was fulfilled. Distribution was 100%, but we should divide it not by the size of the fund, but by the capital invested, right? And residual value is 150, same as fund size, so it's 1x, and together 1.76. And today also we should touch a very important topic. Does venture capital fund outperform public market? And I will show you several screenshots from the white paper, which I will send you this weekend to read about. So, but first we will start from the picture of one of our slides. So we have the funds, we have the capitalization, but this is how it is being compared, right? There are several calculations, methods to compare, but the idea is to put IRR, which is money-weighted calculation, and public market equivalent, which is time-weighted calculation method, on the same page, which is in terms of IRR, and compare what is better. And I will show you today how to do that. A simple situation. We have the PE fund, and we have two cash flows. One cash flow invested, minus 95. One distribution, i.e. we got some money back on the fund. And we have the final NAV at a particular point in time when we try to calculate the IRR for the fund. So this is the actual IRR, which is 24%. And we know that the Russell 2000 index, for example, just any equity index we compare, reasonable to compare with, has these index values. What should we do? We should consider every our cash flow in NAV actually as a part of this equation. So when we invest in the funds, when the manager calls the money, we consider like investing same cash flow into the index. So actually buying some number of stocks of that index. And vice versa when we get the distribution. So if we have a distribution, we consider selling the stocks, right? Consider like an ETF, for instance, much simpler in these terms. So, and this is how it should be calculated. At first, it is 25 million, right? So we invested 25. There is no performance yet of the index, right? We just have bought. So on 25 million. To the moment when we get the first distribution, our first investment has increased in value. 25 multiplied by 150 divided by 100. But we should get rid of 15 from here. At this point in time, it's just 15 because we are not on the next time point. And then when we finally calculate the equation, we do the same math, but we take the index values here and get the final PME, so-called NAV, public market equivalent NAV. That is just the calculation. What's next? You take same cash flows, and this is this NAV, and you calculate the IRR here. And if it is less than the initial IRR of the fund, which means fund was better. Again, same cash flows, same formula, different NAV, which is adjusted. Sometimes we will not be calculating this one, but sometimes that method can get you to the point when this number might be negative. So actually you will be shorting private equity or venture capital fund, which is ridiculous. And there is an adjustment in the method just for you to know that there is a caveat how to overcome it. Usually this is the case when the fund is really good, you have a lot of distributions from that, and you still have to somehow compare it. You use so-called lambda multiple to adjust the cash flows, but use the same NAV. So It's just for you to know. You will read about that. We will not be calculating this one. The easier form of the PME, which is called Ball-Nichols, when you calculate IRRs, is the Kaplan-Shor PME, which actually does similar things, but you compare multiples, not IRRs. This doesn't take into account any time value of your money, but still you can compare. We still have the situation that the fund is better than the public market equivalent. What we do here, we not discounting as in formula with IRR, we just calculating the future values of cash flows. Yeah. So we know that the index return from day one to the last day was 30%, right? And it was 13% from point 2 to point 3. So actually the future value of investment is minus 33, and the future value of distribution is 17. You put it in the same formula, you get the multiple, and you compare them. Any questions? It's not that easy, but just the logic. If the logic is fine, numbers will be fine, for sure. You'll see. And we can do the same, but again, calculate IRRs. That's called, that's called direct alpha. So if we want to know in terms of IRR, how much the fund outperformed the public market, we should use the same thing but calculate IRR not multiple. It shows actually the overperformance or underperformance in terms of IRR. Again, we get the numbers into future, so we calculate the future value of cash flows, but take the same final number that was mentioned. In this case, the fund has outperformed by almost 9% in terms of IRR, money weight, right? So you can look at the comparison from different angles, depending on what is more important. Okay, now we will go into tasks particular, and for me, it is important today that you get the idea, and then you will crunch the numbers yourselves at home, and if you have problems, you come back or write me. Important for me, you are fine with that because that will be on the exam. Okay, let's suppose task 1. That's lifetime fees and potential capital call down amount. Let's suppose we have a venture fund, ABC, which is the size of 300 million. It has management fee, which varies during time, not single. So it's 225 during the investment period, which is 6 years, not 5 this time. And it is 1.25 in the remaining 4 years. Consider we don't have extensions. Remember, extensions is when the GP just increases the length of the time. Yeah, 10 years. So let's calculate the lifetime fees and potential amount which can be drawn down for us as investors. First of all, we take all the fractions of management fee and multiply it by the size of the fund, right? So the fraction is 18.5%, multiplied by the 300, we get $55.5 million. Just for you to get the flavor of the industry, again, if, I don't know, X investors invest in the fund of this size, they will pay in management fee, which is cost this amount of money. So quite actually big number. Right? That's actually the hurdle on your performance. Again, remember, if management fee is part of the commitment, always read LPA, limited partnership agreements. Then the theoretical maximum is 300, of course, right? And here the question might be only what is the invested capital, maybe investment capital. But if not, management fee should pay on top, remember, right? Then potential outflow from investor pockets is 355.5 million, potential maximum. If the fund is normally functioning, usually in the middle of the life, against the capital cost, there will be distributions. So it will be never. But let's suppose the situation when every investment is unsuccessful. So we will be in bad mood and still keep paying money into the fund. This one is clear? Okay. If questions, just don't hesitate, raise your hand or just move. Now, next point, carried interest without hurdle. This is the task. It will be stated similar to that in the exam. So we have the capital commitment of the fund, 100. The general partner called the part of that on the investment at year 1, and another part at year 2. As far as you see, not 100%, only 90% was paid. We have a management fee schedule, simple one. It is paid every year, not every quarter. And we have the simple situation on the whole fund basis with carried interest. Should be calculated. And in 3 years, the general partner has realized the total amount of realizations 120, it's cost plus profit, and we should calculate the carried interest when there is no hurdle. Can you just try to do it and just let me know if it is becoming difficult right at the start? Just a couple of minutes. I will make a short break and we will try to do it. Okay, I will help you. So first, remember, we have 4-step exercise, right? And first step is cost back. So we have to return this cost. Cost of the investments is 40 plus 50, that's 90. Then management fee, 3 years of management fee. Look, you cannot follow that. I will send it this time. That was partially my fault. But as far as I agree, I have already your email on this, my email. So this weekend, you will get 2 presentations on this one as well, 2 previous presentations. So contribution for management fee should be taken back, right? And then it means that 96 is something that investors get first. Remaining capital to split is 24 only. Since there is no hurdle rate, so the sequencing is simple. You just split the profit. We take again 80% of that remaining profit, which is 90.5. And the general partner gets his share of profit. He participates in the performance. He gets roughly 5 million. Any questions? Okay. This is in this task the answer. So this is the carried interest. The general partner gets. Now let's slightly change the task. And let's add a question.
Do we always have 80 to?
No. It can be usually. We have usually. Like, remember Pareto principle in most cases, and same thing here. 80-20. 80-20. That's the normal market practice. Sometimes it differs. In particular, if the manager is good enough, and he might get 2.5 for management fee, and 25% for performance fee. Next step of complication is, let's say you have 20% of carried interest until the multiple to investor, I don't know, is 2x or 2.5x. If it is more successful, the fund, the carried interest increases from, I don't know, 20 to 30. So there are a lot of complications around that, and so they make a motivation for managers. But we should calculate in simple things. That is easier than. Thanks for the question. So same situation, but there is a hurdle rate, right? So 8% and catch up. 100% catch up, that's the easy situation. It's a little bit tricky if catch-up is not 100. It means that when you sequence in these cash flows, you still have to get part of that to limited partners. That's too complicated. But it is more common in more mature asset strategies like real estate, infrastructure. That is more common when the catch-up is not 100. But that's out of the scope of my course. Again, first step is the same, cost back, right? Investment is. Then we should calculate the preferred return. Remember, that's simple IRR formulas, right? So in the first year, we have invested 40% for investment, 40 million for investment, and 2 million for management fee. The life of this cash flow, simply 3 years, right? So we take the hurdle to the power, 1 plus 1. And minus 1 because we have to take the cost basis that. So preferred return for this part of cash flows is 10.91. Same idea for the next couple of cash flows, but here only 2 years. Same for the remaining management fee without investment cash flows, on the management fee. But still some preferred return should be taken back. So actually, to make it simple, we calculate the preferred return on contributions in each year and sum them up, right? So the total preferred return is 19.17. No, that is okay. I will be leaving more space next time. But the total cash flow left, we should take the whole distribution gross on the gross basis on the fund level. Then first should go to limited partner. This should go to limited partner. And then this should be split between general partner and limited partner, but according to this idea with catch-up. And here's where the tricky thing starts, actually. Remember, what is catch-up? Each next dollar being received by general partner before he gets 20% of total profits, if there is enough profits. In this case, as far as I remember, it's not enough. Yes, so actually, this should be the GP catch-up amount, which should go to general partner before any next dollar goes again to limited partner. But since we have less money left, all of them goes to general partner. So GP takes them all. And we have nothing to split after that. So this is a more tricky task, but effectively general partner gets less than 20% in this case, as far as you get, right? Because otherwise he gets 20% of profits once he got this amount. If amount is less, his share in profit is less. So this is where hurdle helps you as an investor in the fund, because you get the money first, and only then the manager takes his part. It helps you in the situations when the performance is mediocre. Okay, but not that good. Should the fund be much more successful, it will not change the situation, right? The sequence will stop and you will be splitting again money between the general partner and limited partner. In the end, it will be 20-80 because there is enough profits to share. In this case, it's not enough profits to share. And this sequencing helps limited partners, so investors. If you have questions, please ask. Okay, if you will have them, just a moment. This is the general partner, the carried interest to general partner, and this is the answer in this task. Another one, just this is another task with carried interest. We have a capital commitment of the fund to 50. GP called on investment 80 in year 1, 130, I'm sorry, in year 2. The management fee is still 2%, paid at the start. And in year 3, we have a realization of 275. And we should do the same calculations. I want you to try to do it now. Let me know which page I should show you. Just take the numbers. Just a moment. Sorry, it's only, it starts with decision. I told you that there was some summary. But If you find, I can put some numbers here. If it's easier. Yes? So fund size. $250. Year one. Contributions in year one. 80. Contribution in year two. 130. So fee schedule. I will put fee schedule here. It's simple, right? That's management fee, that's carried interest. Yeah. And so the distribution potential. Okay, let's actually that's proceeds. Proceeds in year 3. 275. When you get the term proceeds, usually it means on the fund level. So the manager gets from the deal, right? And this is something which should be split down. This is the schedule, but hurdle 8%. Catch up. 100%. And for you just to remind, 4 steps. 4 steps, remember? Cost back, preferred return, which is a function of hurdle. GP catch-up and split. So don't forget to put management fee in your calculations in the check. You ready to start? Okay, just tell me what to do. Maxime?
On the first step, we should calculate our costs for the first and the second year. It will be 50 plus 5 million, so 55 million.
Okay, but this is all together for the whole period, okay? So on this is how 50? You told 50? 50.
Yeah, maybe 80 plus 50, 5 million as a percent.
Yeah, you see, yeah, of course. So it's 80 plus 5, agreed. This is in year one.
Yes, in the second year it was 130 plus 5. And the third year just 5.
Yeah, so it was 5. Yeah, that's the cost. And this is what you get, right? 225.
Yes.
Okay. And next step?
For the next step, we should subtract it from the provision we get from the fund from the third year, and multiply it on the percentage for carry interest 30%.
Okay, yeah. So here's it's vice versa, but still yes. We have only first step and fourth step. If we don't have hurdle, right? So it's easy. You have remaining 50 million, which you split 80-20, so 10 million. This is the general partner's part in profits. So the carried interest in this case is only 10. So we skip this one and this one. No, not much calculations in this case. And decision to be, first step is the same as far as we get. And what did you get for the right calculations?
Then we should multiply it by 1.08 in the power of 3 in 2 years. And then again, we subtract it from the provisions of the fund, and then multiply it on 20%.
Yeah.
To get the
So this is the second step, how we get it. 10 something, that was actually the same thing. So we have cash flows. I put it separately. That's not 85, but still investment cost and fees. Use further rate and to the power of number of years, and take back the cost, right? That's the basis for the calculation. Same thing. We can make it much shorter, but just to better understand, we take the flows in the year 2, take it to the power of 2, take it back as a basis. Same with the last year cash flow. So this is the preferred return, which firstly goes to investors. And did you get the same number? Maybe not that easy, but still, try to check. So then remember, general partner starts receive each next dollar. So it's like considered like a bucket of water. And he starts receiving money until he gets 20% of the profits. But remember, if he gets, it's quite important thing to get it, maybe it will be easier. Let's say we have profits. Okay, profit. And when we have sequencing, firstly, 80% of the profits should go to limited partners. Then, if there is enough profits, let's say we have more profits, this part goes to GP, which is catch-up. And this is 20%. So once I calculated 80%, which is the preferred return, right? In this calculation, 80%, that's actually the preferred return. Because we have split from here again, which is 80-20. So to easily get the flavor whether you have enough profits to share or not, you just take this number, divide it by 4, not 5, right? Because if it's 80 and this is 20, it's 4 to 1. So 1/4 of this amount is something which should be the general partner catch-up. He will get first this money, and if there is still profit, we continue splitting them. But in this case, as far as you get, it's not enough. So again, the situation as with the task before, it's mediocre performance, and the general partner gets less than 20% of the profits, just because there is a sequence. In this situation, when there is no hurdle, the split is different. General partner gets more. I'm sorry, everything is fine?
Я пока просто хочу выключить. А, выключили, если у вас сейчас нет трансляции?
Кто-то у нас там есть.
Есть?
Один какой человек, который хотел прийти, не пришел.
Ну ладно, тогда оставляю, да?
Is it clear with this one? Okay. And again, on step 4, 0 to split, 0, 0. Maybe this helps. Just the idea. Consider a lot of profits, and you just go. You go from here. So all dollars goes to LP. If enough dollars, they go to general partner, catch up until this is 2080, but okay, 4x, 1x, right? Altogether, that's 100%. If we still have have something, we just split it in the same proportion. That's the most complicated thing, actually. If you get this one, you're fine. Now the task with multiples. And I hope you to do it at least partially yourself. Give you 7 minutes. So we have the fund. It has a commitment. Most part of that has been called. The fund has exited one of the investments, so this should be distributed there. It made distribution to investors, but be careful. I'm not saying here that 60 million was distributed. I'm saying that there were proceeds and there was distribution. But distributions might be different than proceeds. And we have the remaining part, the valuation of the remaining assets in the portfolio 102. Simple case, no management fee. Simple case. But there is a carried interest, but deal by deal, in this case. You should calculate these multiples. Remember, paid in capital, right? That's the amount paid in to the size of the fund, to the commitment. Distributions to paid in. That's the most trickier part of this task. And the other two are simple. Please try to, okay, this is the summary for you. And then you should try yourself. So commitment, actual paid, realized profit, gross on the fund value. Tell me when you're ready. Just go step by step. Start with simple. Paid in to paid in capital. Amount invested divided by the size. I got the letter. That's fine. Why the name of the email is Heseye FA 2020, not 2021?
It's the number of the group, not the year.
Okay. On the other hand, this is your first year. You started in 2020. Okay. Now we got it. Thanks. So how is it going? Is it the hurdle? Okay, let's move on. So actually, we have commitment. We have the capital called actually less than 100%, and again 60. That's the profits. I decided to. Yeah, profit. Profit means that's already the something on top of the cost, right? So it should be. So let's calculate simple. 20% on a deal-by-deal basis of the profit, which means that general partner will get his right. So LP's share in profits will be less than 60. That will be only 80% on the profit, and the profits will go to the limited partners. We have NAV. So peak is 130 by 150. is 0, almost 0, right? Distributed to predict. Let's say we are distributing only profits, and there is a small caveat in the task. Let's say the profits only distributed, but the cost basis is staying for another investment because the fund is mine. Then 48 should be divided by the total amount of contributions. So it's 0.36. And never mind about TVPI. If you get two other multiples, you will just sum them up. So TVPI usually also quite simple thing. You just take the NAV and divide it by the total contributions. So usually the most tricky part is distributed to payment. Just don't forget to take back the carried interest if it is should be taken. Okay, and now let's talk about benchmarking until the end of this class against public markets.
Excuse me,
Yeah.
can you just previous slide?
Sure, which one? This one?
Извините за русский.
Да.
Правда, вот коммитмент мне понятно, это размер фонда. А что capital call? Это у нас что? Сколько мы реально прикрепили, получается?
Сколько мы put yourself in investor всегда просто представить. То есть сколько вы уже вложили в фонд. Commitment, remember, commitment it's obligation, no cash flow statement. Это как кредитную линию. Вы подписываете кредитную линию в банке, но вы не выбираете. Банк вам обязан дать деньги, у него commitment перед вами. Вы ему за это платите. Когда вам надо деньги, вы берете.
То есть мы собрали уже 130, получается.
Здесь вы только не путайтесь, кто вы менеджер или вы инвестор. Я предлагаю всегда одну сосну выбрать и за нее держаться. Put yourself in investors. Сколько с вас взяли?
Про 150 договорились, 30.
Про 150 договорились, а 130 уже у вас забрали.
И получили у нас 60, да? После четвертого круга.
А это на уровне фонда прибыль, что менеджер заработал. И он ее хочет поделиться. Он себе что-то забрал и вам что-то отправил. Sorry for Russian, those who will be looking. Okay, let's now move to another task, which is the comparison with public markets. I tried to cover that for you to easily read that. So actually, we have 2 dates. Today is 2018. We're making the report, and we want to calculate the fund, the VC fund where we are invested, and compare that with the bench, I don't know, index in index. Your boss is asking, was it better to invest in S&P or be in the fund? I don't know, Russell, be in the fund. And you have to answer the question. This is how we will make it. That's the simple form, of course, right? One cash outflow, one cash inflow, and the remaining part. So we invested 50 million, that's C contributions. In 16 months, we get most of that back in the form of distribution. And as of the end of the 2017, we still have the 24 million valuation in the fund, right? The general partner gave us the financial statements, and the valuation for us is 24. Nobody says it's cash. Nobody says it will be 24. It might be 20. It might be 0 million. But as of this cut-off date, this is the best information we have. The index values as of those dates is the following. In this case, it's simple. It is growing, right? It might go down, of course, as far as you know. So index return, look, this is it means from this point in time to this point in time, that's 28%, right? Increase. From this point in time to this point in time, that's 10% increase. So here, of course, it's 0. And we have to answer whether it's better, whether the fund is better. And we have to calculate it using Coulomb-Nichols, which is IR versus IR, Kaplan-Shor, which is TVPI versus TVPI, and direct alpha. If there is outperformance, by how much? Okay, now let's look at that in more details. This one is easy, right? You just take Excel, you take Nuance чистый индох, XIR expression, and you get this number. 14.9. Here, this is what we should calculate to get this final number, which we will be using here. Remember, each cash flow is calculated based on the index values. So you adjust by the index value to get to this final number, which is 22.1. We put it here. It's obvious that the IRR will be less, right? If we have same cash flows, but NAV used in the formula is less than the initial one, which means that IRR in this calculation will be less, which means that your fund, as of that point in time, outperformed. So you might say to your boss, look, as of the last date when we have the reporting, it seems like our fund is better than investing those same cash flows in and out of the index or ETF. Which is fine, right? Because the fund is illiquid, there should be some premium. Does it clear? Is it clear?
Sorry, once again, how do we know that we have outperformed it?
Again, yeah, of course. I know that's not the what. Yeah, that's cool. This is our IRR of our fund. So this is what we can show to our colleagues and bosses and say, look, our cash flows, given the valuation of the manager, provides us with almost 15% IRR of our investment in this fund. Should we invest same money in and out of, I don't know, particular index, which you consider relevant to you or to the strategy? It's also the case which one to take, but still, we will get IRR which is less. How we get that? We take same cash flows, but they use another NAV, net asset value. But the net asset value is just the, consider that you invest money into the strategy, into ETF and out of the ETF on same dates by the same amounts, and you actually left remaining with this valuation of your investment on your investment brokerage account. And if it's less, the IRR will be less. So you might state that the VC fund outperformed because IRR, initial IRR is higher than IRR, which we will get if we invest in the public market. Why we use IRR here? Because you can compare IRR with IRR. You cannot compare this index returns to IRR because this is time-weighted return and this is money-weighted time weighted return. The sequence and timing of cash flow here is important. Here, it's not important. So you should consider the same metrics, right? Only in this situation you might state anything about over or under performance. Move on. Okay. Oh, we have somebody in the chat. 10 million to GP. Yes, Sergey. Sorry, I just have seen that. Yes, that was fine. Now let's consider another method, which is Kaplan-Shorty. Just look at LM and KS. That will be easy. Again, in this situation, we use this index values just to calculate this number, which we put in here. All the same, all the rest stays the same. If we don't care about time of the money, time value of the money, we just want to calculate in terms of multiples. We calculate not IRR but multiple. That's easy, right? Positive divided by negative. Your cash flow plus your valuation, that's TVPI multiple. And you take the cash flows into the future. You use the same index returns to take cash flow into the future. So this minus 50 increased by 28% will give you minus 40, minus 64. So this plus 38 increased by 10% will give you 41.8. So you take these cash flows in here but you use the same NAV. I'm sorry, this. Maybe this. So what we get that the multiple is more than 1 here. So venture fund has outperformed. We don't compare this multiple to this one, but we just we use the same formula here. So first, this is the formula. You use the same formula, but in this formula you change these cash flows, right? If you get more than 1, it means that your fund has outperformed. But 3% over 1% over 1 is doesn't feel much higher, right? But remember, we don't consider time value of money here. But still, another proof that fund should be considered better. So again, IRR, same cash flow, different NAV, different cash flows, same NAV. That's good. And now let's answer the question by how much in terms of IRR. Usually IRR is something which everybody likes. However, it's that metric. You can remember, I'm sure you're familiar with that, but if you have a big increase, I don't know, good deal at the start of the fund's life, you lock it and you distribute huge amount of capital back to investors, you actually lock in high IRR. You might have mediocre investments after that, but in terms of IRR, your fund will be like that. But in terms of multiple, it will be much less. So always look from different angles. This is the direct alpha method. So we use the same thing. We take flows into the future to the date when we want to make a conclusion. So same situation. But here we use the IRR formula. And it shows you but by 2%, which is almost the same. Look, it's almost 15. If you look here, you will see that the difference is if you just take one IRR and divide another one, not divide, but subtract. Sorry. You have 2.2, right? But remember, you should not subtract, but use the divide. But it says you that it's roughly by 2% in terms of IRR. And actually, for today, that's it. And then we'll have some time for questions and answers. Which task for you at the moment seems to be the most complicated?
Maybe this one.
With all these metrics, right?
Yes.
But you will calculate that yourself. But do you get the idea? So again, we're an investor. We invest in money when we ask for, not when we decide, but when we ask for, right? We give the obligation. We keep our money somewhere on accounts, not getting returns from public markets, because otherwise you might be in a situation when you have to sell when you need money and the market is down, right? Actually, that's the hidden cost of all this private venture capital, etc. We are putting money into the fund, we're getting some distributions from the fund, and every time we have some valuation of the fund. So we can calculate IRRs, but we always should keep in mind that we have other opportunities, right? We might invest in public markets, in small caps, I don't know, not only in the US, but etc. You can consider the situation, let's say that it's a venture capital fund, you might invest not in NASDAQ, of course, but in some small cap technology companies in the public market, which actually swings by 50% easily, up and down. And for you, it should be a question whether it's better to provide money to the manager and bear some hidden costs, or just invest directly into the public market. That's why you want to make this kind of exercise. It's not a deal breaker for you, but it's part of the analysis which you better do with your portfolios, with your funds in your portfolios. You can do the same situation not with one fund, but with portfolio of your funds, right? You can pull together all the cash flows because one or another fund might be much better or much worse than the public market. But your portfolio in aggregate might show you, I don't know, much robust results. So it's a universal exercise, actually. You can go up, and put more and more funds into the portfolio and make these calculations. By sub-buckets, for instance, if you have venture funds, you use technology index. If you have private equity funds, you use, I don't know, S&P or S&P 600, which is small caps, but still private equity, more close to private equity companies rather than venture companies, etc. And here we have like simple stuff, either in terms of percentage points or in terms of multiples, which sometimes calls multiple invested capital. I'm sure you know about MOIC, which is multiple on invested capital. Some people use it cash on cash basis, MOM multiple, but idea is simple. So actually, cash flows, valuations, we can get our percentage points in our formulas in Excel, compare that with this type of calculation. If it's important for us to know the time value of money, if it's not important, sometimes it's not, you just use the formulas with multiples, which say you, okay, you invested, I don't know, X million dollars into the strategy, into the portfolio, and it still, in terms of dollars, absolute dollars, gives you better performance rather than investing into the index. And if somebody will ask you by how much, you say by 2% in this case. More or less, that's you should understand that it's not particularly like exact number, but it's more or less close to true, right? But when we talk about this case in general, this number is more or less the truth, because we get this number in April. Usually funds provide yearly financial statements 4 months from the end of the year. So 4 months into the new year, you just start making calculations, right? They say, look, as of the end of 2017, in this case, your value stake in this portfolio was 24, but at the moment, it might be much different, right? So we have this big time lag, which actually also, so that's fine, right? If your numbers are not exact, because the number you use in your calculation is outdated already. Still, it gives you some flavor. Okay, I hope it was valuable for you. As agreed, I will send the presentations. What I need from you, now you know my email, but I need from you is, I need from you the list of people in the class with Gmail accounts. Just for me to take these Gmail accounts and connect it to Google Classroom, where I will be, where you will see a lot of stuff. I will provide you white papers, because email is not efficient now, especially one for everybody. But you will be just, like it will be a virtual class, you will get into the class, you will see task 1, task 2, you will get white paper, you will get the task. I don't know, it will be much easier for you just to track your success. Okay? Who is the senior person in your group?
We have no senior person.
No? Stars.
No. Not yet.
I see. Moment, I have to switch this off. Good morning, dear colleagues. Please let me know whether you can hear me.
Yeah, good morning. It would be perfect if you could add a little bit of volume.
Volume.
Yeah, a little bit.
What about now? Is it much better?
I don't think anything changed. Can you try again, please?
The volume is on maximum.
Okay, that's fine. That's fine, actually.
It's better now, yeah?
Yeah.
Okay. So shall we wait for more people to join? Maybe. Okay, let's wait for another 2 minutes, and we will proceed. Okay, let's proceed then, colleagues. It's slightly unusual to be in the class without anybody else in the classroom. Before we continue, my question would be whether some of you are planning to visit in-class classes, or all of you have already chosen for themselves that you will be on the online. Okay. Okay, so those who say they will visit offline, you are not here today because it's a one-off event, right? So for me, it's just important to understand how many people will be visiting the class, and whether there is a sense to split the group for seminars or not. Okay, I see Ilya, Luke, and Nikita. Next time, perhaps. No, if you want offline, please come to 10 a.m. Because otherwise it doesn't work. I have to be here at 10 a.m. without anybody in the room. It's difficult. Okay. Okay, I encourage you, those especially who have been vaccinated, to come into the class. And it seems to be more efficient and interesting rather than being online. But still, I will try to keep the level of analysis the same. So now let's move on. Just let me know if you you see that. Just a second, please. Do you see the presentation now?
Yes, we do.
Perfect. Now let's continue. So today's seminar, and it's the first seminar, and we will be covering venture fund metrics and performance evaluation exercises. Some of those tasks will be quite similar on your final exam and intermediate test. And so please raise your hand or just voice or ask me if something will be not very much clear. Just for you to remind some slides from previous presentations, which actually I will send you this weekend. I already got the email from your colleagues, and all the other instructions I will write down in email. So remember, this is the simple fund structure, and the fund pays carried interest and management fee, and these two things will be part of the focus of today's lecture. First of all, management fee and expenses. Just for you to remind how it works, we pay management fee every year for a number of years, usually for the term of the fund. So there is a term so-called lifetime fees, which says how much capital will be spent on expenses of the team just to run the vehicle. They will not be used for investment returns. They will not be used for other things. It's just the hurdle, right? You carry this expense as an investor in the fund. The fund doesn't work without management fee. And the remaining part of the capital is the money which will be invested into the companies with the hope to provide the returns, right? So total commitment should be decreased by these lifetime fees if management fee is part of the capital commitment, right? Here I want to stress you again, should you encounter venture or private equity funds in your career, always read carefully limited partnership agreements or simply LPAs. That's their important document, and usually in sections 5, 6, or 7, there is so-called waterfall distribution bucket, and here you here you have to carefully read all the nuances, how the waterfall works, whether the management fee is part of the commitment or not. And if management fee is not part of the commitment, so it goes on top of the commitment itself, you should be ready as an investor to potentially higher outflow from you in terms of funds. So remember that. Simple exercise from last lecture, just for you to remind again, we have a fund of size 100 million, standard 10 years term, 2 extensions, but we don't consider them here. Half of the period is investment period or commitment in some cases, just different name. And the remaining, of course, is harvesting period. Management fee is standard, 2% per annum. And the distributions works simply. So first, capital cost or contributed capital on investments and expenses goes to limited partners. The remaining profit, if it exists, is being split between investor and manager. So what is lifetime fees in this situation? Every year, 2% should be multiplied by the base. Base is capital commitment, which is in this case 100%, 100 million. And it will be done 10 years, for 10 years. So you have to multiply 2% by 100 million by 10 years, and you will get 20 million out of your commitment being spent only on fees. So the remaining 80 only will be invested into the companies, venture promising companies, which hopefully will provide the fund with returns and manager with bonuses. If management fee is not part of the commitment, then you should understand that the investment capital is actually your commitment, which is 100, but this 20 million will be paid on top. So actual outflows from your pocket will be higher potentially on a gross basis, right? So it will be 120. And usually management fee base changes after the investment period, and one of the tasks today will show you that. Okay, and carried interest, just again, small reminder to you. It's the share of profits which GP takes. It's paid only on cash basis, so no realized profits, no cash basis, no bonuses, no carried interest. Usually it's 20%, but it might be a different number in some cases and very well-known funds. Catch-up provision is important if there is a hurdle rate. Catch-up provision, well, it's only works with hurdle rate. No hurdle rate, no catch-up. And sometimes carried interest may be subject to escrow accounts, but that's a legal point. If you're interested, you can Google that. And the final reminder is that carried interest might be in two forms: investor-friendly, which is whole fund basis, or sometimes it's called European-style waterfall, and more general partner-friendly is deal by deal. Yeah, I see somebody wants to say something. No? Okay. This is how it usually works. On the left, you have all the capital, cost plus profits, and it goes in sequence to first investors, the cost and the hurdle rate or preferred return. And then if something is left, goes to general partner as a bonus. And if still something is being left in terms of profits, it is being split again between the investors and the general partner. If there is no hurdle rate, we just have actually two steps out of four, the first and the last. So we get all the costs back to the investors, and if the profit exists, we split it, and that's it. And if there is a hurdle return, it actually makes the sequencing slightly different. We again take the costs, put it, cost goes back to limited partners, then something else goes to limited partners, which is preferred return. Then general partner gets his part of the profit, but only after limited partners have received minimum IRR return of 8% in this case. And in the latter step, the remaining profit is being split again. Okay, this is the simple task. If let's say the 100 million was called down on year one, management fee was 2%. In this case, it means 2 million per year, right? And in 3 years, the 150 million was realized from the portfolio. In this case, one investment. So let's find distributions to limited partners and general partners, and find actually carried interest, which goes to general partner. In this case, decision is simple. First step, remember, cost back to limited partners. What is cost in this case? That's the 100 million investment itself, plus 3 years of management fee payments, which is 6 million altogether. It gives us 106 million. This is first cash, which goes to limited partners. Then, as we don't have any hurdle rate, but still have profits to split, we split it 80% to 20%. So 80% of the difference between 150 and the amount on the first step goes to limited partners, and 20% of that goes to general partner. And the general partner in this case gets $8.8 million US. And actually, in this case, that's his carried interest. Let's consider now the situation when the hurdle rate actually exists, and all the other numbers are the same. Let's find the general partner carried interest in this situation. First step is the same, 100 plus 6, 106. But then we have to calculate the preferred return. Consider that calculation as an exercise with deposit. All your cash flows into the fund. So for you, actually, it's contributions, but they are outflows from your pocket. Consider that they should go to deposit with 8% IRR, in this case, with 8%. And you can just calculate all the numbers. How much capital would you accrue to this deposit, so-called deposit? So in year one, you invested 100 and first part of management fee, which is 2%, right? So 102 should be multiplied by 1.08 to the power of 3, because it's 3 years, right? At the start of year one, then year two, then year three, but then end of year three. So from the start of year one to the end of year three, we have 3 years of accruals. And don't forget to subtract the base itself, 102. Same calculation should be done with management fee in year 2 and year 3. But in the former case, you have to put it into the power of 2, and in the latter case, in the power of 1. In the end, we got almost 27 million of preferred return, which again should firstly go to limited partners, investors. Then we understand that we still have capital to split, but now general partner who is getting all the dollars until he receives 20% of the profits, right? So the 20% of the profits is 6.75 in this case, and this is how we get it. You can easily calculate this number differently. Amount on the step 2, which is second to limited partners with preferred return, should be 80%, which means that 1/4 of that amount should be amount on the step 3 to the general partner. If you combine together these two numbers, it will give you the profit, which should be split among limited partners and general partners before step 4. And only then you split it again 80-20. So this is the calculations. We get that actually general partner has got 6.75 million on step 3 and additional 2.05 million on step 4. And his carried interest in this case should be the sum of those two amounts. So it will be roughly 8,077,000. I'm sorry, 8.8. In this case, the number is the same as on the previous example. You see, it was 8.8. And here, if you combine them together, they will give you 8.8. The answer is why, on the question why, is the following. The strategy was successful enough and provides enough profit to share. In the situation when the profits are smaller, the situation will be different. Guys, any questions on this step? Okay, I will continue. Don't hesitate to interrupt me either by voice or by chat, in chat, okay? Evaluating fund performance. Now, remember the metrics. Remember, we have 4 major multiple metrics of the fund performance. First is peak, which is paid in capital. That's capital divided by the commitment. It shows you the proportion of capital actually called by the general partner. DPI, which is distributed to paid in, it's the cumulative distributions which you receive as investor from the fund divided by the cumulative invested capital. So actually, what part of the money you have already invested into the fund you have got back. And there is also RVPI, which is residual value to paid in. It actually shows you the unrealized amount in comparison to your investments into the fund. And total value to paid in actually shows you the total multiple of your investments. And I'm sorry, it consists of 2 multiples, which is RVPI and DPI, and it shows you the sum of unrealized part and realized part of your investment into the fund. Just for you to remember, that was the exercise, simple exercise from our lecture previous time. That was the fund of size, best VC fund with size 200. Actually, only 150 was invested and 100 was distributed. The valuation of the portfolio was 150. In simple terms, the multiples were as follows. So paid in capital was 150. That's actually all investments into the fund divided by the size of the fund. So it's 0.75. 100 out of 150 actually invested into the fund was distributed. Residual value 150 divided by the same 150 invested provides you with 1x in the fund, and the sum of the last 2 multiples gives you the total multiple of your investments 1.70. I'm sorry, 67. And remember, there was also one question we asked ourselves last time: does venture capital fund outperform public equity market? And we saw that there are some metrics, which is PME plus or PME metrics used to compare. To the right, you see the Preqin Private Equity Online picture, which shows you that actually venture capital was supposed to be better than the public markets in this case. Today we will touch on that very much. And this is how it should work next. So there are several important things to compare. This is from one of the paper, and I will send it this weekend to the group to read, actually. But first of all, I want to go with you into details with that. So consider the situation: we have the fund. We have contributed to the left and up to the left corner, please, P fund. We have contributed 25 million into the fund at the start of the year 2018. Then at the end of that same year, we have distributions received, which is 15. And at the end of the year 2019, I'm sorry, yes, 19, we still have 20 million left into the fund as a valuation. So if you simply calculate the IRR, it will provide you with 24.3 percentage points. Let's suppose we have a relevant index where we could invest our cash flows instead of putting them into the fund. Let's call it just index. Our idea here is to calculate the theoretical IRR of the investment into this index rather than to our fund. And what we do, we take same cash flows on same dates and invest them into the index or out of the index in case of distribution to get the final NAV in terms of dollars. So in other terms, should we invest our cash flows into the index or ETF, what amount in terms of millions we will get in the end? In this situation, as far as you get, it's 25 at the start. Then in the middle, when you have already distributions, to that point in time, your investment has already increased, right? You invested 25 at the start of the year, and the index increased by 15%. So you multiply it by 15% actually, but you subtract this cash, which is distribution. So actually in 1 year, you sell for 15 million from the index, and you left remaining with particular amount of dollars. If we go again further on, at the end of the year 2019, our investment into the fund, the first investments, which is 25, would increase by 30%, right? But our distribution cash flow would also increase by not 15%, but by the number which you get dividing the index values 130 by 115. So in the end, you get the calculated PME net asset value, which is 15.5. What you should do, you just have to substitute the actual NAV in the fund, which is 20, with this PME NAV, which is 15.5. And you make the calculation of the IRR. That's called Klon-Nickels PME. That's the two family names of people, but interestingly, like buying Lon-Nickels, but not actually. That's family names. In this case, you see that theoretical IRR of investing your money, same cash flows on same days in the index, provides you with IRR which is less than the IRR of your fund, which means that your fund should be considered outperforming the public market in this situation. So again, we have here same cash flows but adjusted asset value. Sometimes in this situation might be the case then if the fund is very successful and provides a lot of distributions, you might be actually having negative PME net asset value. or in our terms, being short the private venture capital fund, which is ridiculous, right? So there is a caveat around that. To have the multiple called lambda, you see here, it is used to get the similar IRR. It is not something we will be calculating today or having on exam. It's just for you to know that there is a problem with this method and there is the way around that. It will provide you more or less the same results, but you will be using adjusted cash flows. You will read about that in details. And now let's move to the point which is more important to us. Instead of IRRs, when we take into account the time value of money, we can compare multiples if we don't care about time value of money. If for us, more importance should be stressed on, I don't know, actual increase of total amount, right? Should we invest $1, whether we get, I don't know, how much dollars actually we get, regardless of what I have. And here the logic is slightly different. We start with the same, but we calculate initially not the IRR, but the total value to pay in, 140 in this case. It's easy to calculate, right? You take 20, you add 15 to that, which is 35, and you divide it by 25, which is initial investment. So actually, NAV plus all distributions should be divided to all contributions. It's just standard multiple. But what you do to the right is not you calculating IRR or you're trying to go in and out of the index. You just take all your cash flows into the future. So you calculate future value of your net cash flows. As far as you see in this case, 25 millions invested initially becomes minus 33, and 15 millions, which you get as a distribution, becomes 17. What you do, you just subtract the actual contributions and distributions with these future values. You use the same NAV in the end, and you get the multiple, right? And if this multiple is more than 1, you should not compare it with the previous multiple on the top. You just should use the same formula, but you should look at the number in the end. If it's more than 1, it means your fund outperformed public market. If it's less than 1, the fund underperformed the index. So again, come back. We can calculate IRRs and compare them, or we can calculate the multiple and compare it with 1 to make conclusions. And if we are asked, but if our fund has outperformed, then by how much, again, in terms of IRR or percentage points, there is another method called direct alpha, and it's a small deviation from the 2 previous exercises. So we start at the same, we have the IRR formula. What we do in our calculations, instead of actual cash flows, we put these future values, but we calculate not multiple, but the IRR. And since this direct alpha positive, it means that our fund has outperformed the public market equivalent, which says that roughly, by roughly 8%, 9%, which says you that the market itself provided IRR about 15, and about 9% was the outperformance number. So today we will show you this with other numbers. So guys, it's quite an important part. Of course, you will read the paper and it will become much clearer, but you can ask me questions if something is very much unclear still. Please. I'm sorry, I will just double check what's that. Okay, guys, let's continue now again. Task one is about carried interest. We have a venture fund which has raised 300 million. So actually the size of the fund. The management fee or fee schedule is slightly deviated. So we have 2.25 during the investment period, which is 6 years out of 10, and 125 after the investment period. So in the remaining 4 years of the fund's life. Let's calculate the lifetime fees and the total possible sum of all capital calls during the fund's life from investors' pocket. We are paying 225 6 years, and we are paying 125 for 4 years. We have to calculate this sum and multiply it by the size of the fund to get the amount of fees which supposedly, will be paid to the manager of the fund during the fund life. So investors will be paying this amount of money only for costs. That's sunk costs for them. And here is tricky thing. If the management fee is part of capital commitment, again, then still 300 million is the maximum theoretical capital takedown amount. But if not, remember, management fee might go on top of capital commitment. Then we should add this amount to the total capital commitment to get the theoretical maximum of outflows from the investor's pocket. So actually, subscribing for 300 millions, in some cases, you might be subscribing for 356 millions almost. Now let's move to task 2, which is calculation of carried interest without hurdle rate. And let's say we have a capital commitment of venture fund of 100. The general partner has already called down 40 million at the start of first year, right at the start of the fund's life, and 50 million at the start of the second year. Management fee in this case only 2%, paid at the start of the year. The waterfall is whole fund basis with 20% IRR, carried interest. At the end of year 3, again, at the end of year 3, general partner realized 120 million of proceeds from investment. We should calculate carried interest attributable to general partner in the case when there is no hurdle rate. I will show you the first step, and we'll give you a couple of minutes, maybe 3 minutes, just to try to continue. So return costs goes back to OP on the first step always, right? So first of all, contributions for investments, which is 40 and 50 together gives 90, goes to investor first. Don't forget about management fee. It was $2 million US for each of the years, so altogether 6. So $96 million out of 120 should go to limited partners. And the remaining capital for distributions among the limited partners and general partner is only 24. So the question to you, try to answer it, a couple of minutes, how it will be split. Remember, no hurdle rate. Can you please calculate the split of this 24 million? Did you get it? Please let me know if you find. Okay. I hope you at least tried, because you will have in the end. So remaining capital should be distributed in proportions 80-20, right? 80 to limited partners, 20 to general partners. So limited partners will get $19.2 million and general partner will get $4.8 million. And this is the right answer in this task. The general partners carried interest is 4.8 million. I hope this is clear, and now we add the hurdle rate in the equation, and it will be much more interesting. Same task, same capital commitment, same cash flows, etc., but we have the hurdle rate, and GP has 100% catch-up. It is easy, and now let's move to preferred return calculations. So again, in year one, we have invested 40 for investment and 2 for fees, right? These cash flows were invested for 3 years. So we take 1 plus hurdle rate to the power of the number of years, which is 3, subtract 1 as a base, and get the preferred return on contributions in year 1. We do the same math for year 2 and year 3. So in year 2, we invested 50 for investment and 2 again for management fees. We take 1 plus hurdle rate to the power of 2 in this case and get the number. And do the same with the year 3. Putting it all together gives us the total preferred return to limited partners, 19.72. Which means that total capital left for distributions among limited partners and general partners after this second step should be 120 minus 96 from step 1 minus 19.72 from step 2, which gives you $4.28 million left. And now we have the step 3, which is general partner catch-up. Please be cautious here. Remember, what is catch-up? That's the part of the waterfall when general partner receives every dollar, so also 100%, every next dollar, until he has received 20% of amount in step 2 and this step 3 where you calculate that. How we get that number? Maximum amount possible is 20% of number we get from step 2, which is P2 here. You should normalize that to 100%, right? So you divide it by 80%. What you get? You get 20% should be taken from the amount which should be got from 19.72 from the step before, normalized to 100%, and you get 20% of that. So effectively, every next dollar until GP gets 4.93 million should go to general partner. But remember, we have left only 4.28 after step 1 and 2. Effectively, general partner takes all that, but not more. No more remaining capital left to split. So actually, not enough profits to split in step 4. So everybody gets 0. So in this case, this is the answer to the task. Actually, the general partner's carried interest is 4.28. And that's it. Before we go to another task which you will have to make on your own, please ask any questions you have.
Yeah, could I ask a question, please?
Sure.
So if I'm correct, the limited partners get 19 and 2, and GP only get 4 and 28, right? So
GP gets 428.
so LP
You ask-
gets full amount, but GP gets less than 20%, which we calculate.
Remember, GP gets 20% not of all cash flows, but only of profits. In the step one, we calculate the cost, total cost for investments and fees. So actually, if all your proceeds from all the investments is 120 in the fund, you should subtract the cost on step one, which is 96, because you get 120 investing 96, right? So if you want to get part of the profits, first you have to get the profits. In our calculation, profits is only 24, which is on step one shown. And general partner should get 20% of profits. If no profits, there are no profits, no 20% of profits. In simple words, should be 120 be 96, there will be 0 profits to split, right? So limited partners will just get back their capital with 0 performance. And of course, general partner cannot get any of that. That's just illogical, right? So actually what we split the profit. But if we have hurdle rate, the sequence of splitting is just not, is just in our favor as investors. In this case, if there are not enough profits, we still get at least 8% IRR. Understand, right? And the general partner will get something. Effectively, he will get less than 20%, but we encourage him to get 20% only in the situation when we get at least 8%. Because for us, investing in liquid fund for 10 years, for getting less than 8% expectedly, right, doesn't make a lot of sense. At least 8% should be something. That's at least positive return.
So if we get more than 120, should we then split 80 by 20, right?
Yeah. Look, in this step 3, we have calculated the theoretical value of GP catch-up number. It's just effectively the next part of profit. Consider that simply. So I will try to show it here. Do you see the board?
Yes.
Yes. Do you see this picture?
Yes.
Okay. This is something I have shown to your colleagues. So consider the situation that we have some profits, right? It might be small profits, larger profits, or very large profit. So, and you goes and consider like a bread which you eat. First, limited partners eat their part of the bread. If it's enough for 8% IRR, then you take this bread and give to the general partner, and he starts eating that, his part, which is general catch-up. We do it so that we get 80% and he will get 20%. So if there are enough profits, we will take, I don't know, 4 centimeters and he will get 1 centimeter of this bread piece. And if there are still some bread left, we keep eating that in proportions 4:1 or 80 to 20. But the idea is the bread is started to be eaten by limited partners. They get this 8% IRR here. They say, okay, I'm ready to split with you. I don't know, to give you part of the profit, part of the bread. Then general partner starts eating. Then he says, okay, it seems like I got my part. Now let's split it in 4:1, and you start eating that. So actually, 4x and 1x altogether gives you 100% in this case. And catch-up is just the sequence. If you have enough profits, effectively you always will get 4:1 or 80 to 20. But if you don't have enough profits, in this case, it will be like that. So no more bread. In this case, limited partners got this, but general partner got only this. And effectively, it will be, of course, less than 20% of total profit. Remember, 20% of total profits. Here was the cost. We doesn't consider that, right? It always goes to LP. I hope that's That's clear. That's better.
Yes, thank you very much. Bread explanation is perfect.
Yeah, just consider that I don't know, sandwich or something like that. Okay, now let's move on. Now let's add the hurdle rate, and it's another task. We have the fund of size 250. The general partner has made 2 capital calls in year 1 of 80 and in year 2 of 130. Management fee is simple, 2% per annum, paid at the start, and it's whole fund basis again. In 3 years, the general partner realized the portfolio for 275 million. 3 years, of course, is quite short, but just compare this simple exercise. We should calculate the carried interest attributable to the general partner in the 2 cases, of course, with and without hurdle rate. Always consider GP catch-up 100%, because if the GP catch-up is not 100%, it means that general partner, when he is eating his part of the bread, always gives some pieces to the limited partner still. It complicates the calculations, and it's not common in venture funds and even private equity. However, in real estate and infrastructure funds, that might be a case more often, just for you to know. In our case, it's much more easy. So let's calculate. I mean, you calculate that. I will leave you for a while with this task. Please try to do that on your own. We will go through that. I need you to start doing these exercises because you're learning by doing. I will be out for maybe 2-3 minutes, and we'll come back soon. Okay? See you soon. Okay, I'm back and we should proceed. How was your success? Did you get the same on step 1? So this capital first should go back to limited partners. Nobody is answering. I don't understand whether you are here or not.
Can you please explain how we got 5 multiplied by 3?
Sure. Thanks for the question. Okay, again, let's go back. We are calculating all the numbers after 3 years have passed. We pay management fee every year, 2% of 250 million, which means 5 billion every year. That's why we multiply by 3. So we
Sure.
Yeah, sure. That's the reason. Should it be 10 years, you should multiply by 10. Remember lifetime fees exercise, the simple one before? Always keep that in mind. The longer the period, the more you pay just for expenses. In a normal situation, limited partners should get back the investment cost and the fees. It's not always the case. Always read the limited partnership agreement. Okay, what about step 2? Did you get the same number? If no hurdle rate, you just have to split. We don't have step 2 and 3. We actually go way straight to the step 4. So we have only 50 million left to split. That's actual profit, right? Because on step 1, it's only cost. We have to subtract that. So the profit is actually 50, and it should be split 80 to 20, or 40 million to 10 million. In this case, general partner gets $10 million as a carried interest. Now let's consider decision for case B when we have hurdle rate. Step 1 is always the same. Step 2 and 3 should be added in this case. What we do? We should calculate preferred return. We always take the cash flows by years. It's slightly complicated here. I tried to put it simple for you to get the flavor. So in year 1, we have invested 80 million for investment in particular company and 5 million as a management fee, the cost. This cash flow lives 3 years. Consider that as a deposit. You invest for 3 years at 8%, 95. You should subtract 95 itself as a base to get the percent on your deposit. You do the same exercise for the cash flow in year 2, which is 130 for investment and 5 for management fee, multiplied by 108 to the power of 2, because only 2 years is left until the point we try to calculate this. And don't forget to subtract the capital itself to get the interest. And same with the last cash flow, which is only management fee in year 3. At the start of year 3 until the end of year 3, you have to accrue only 8%. So what we get here, the preferred return to limited partners is $44.94 million, but not million here, just dollars. And then we have this tricky situation when we have to calculate catch-up. In this case, there are not enough bread to go to split. In this case, every next dollar goes to general partner until he receives 20% of distributions above 225, right? But it's not more than 11.24. How did I get that number? It's 1/4 from the number above, which is 44.94. Remember, it's always 4x to 1x in the situation when you have 20%, okay? So I know that all the money on this step until 11.24 should go to general partner. Then we will still have some bread left to eat it together. But in this case, the piece is smaller. It's only 5.06 left. Remember, 225 plus 90 plus 44, I'm sorry, 94 out of 275 gives you that only 5.06 is left on the table. In this case, everything should go to general partner. And we don't have anything to split. We have already eaten all the bread. That's it. In this case, the general partner carried interest is only 506. Compare that with the situation on the previous example. That was 10. So what we got in this situation? Hurdle rate actually is very beneficial to you as an investor in the venture or private equity funds in case when the performance is so-so. It's still positive, but not that much great. In this situation, you encourage the general partner to get more in terms of profits, to get his 20% of profits. Otherwise, preferred return will go to limited partners. So if the IRR of the fund is 9%, most of the profits will go to limited partners because they, should get at least 8% IRR, right? Without this hurdle, you will split all the profits 80 to 20 with hurdle rate, and actually you will get less, right? In this case, you get almost 45. On the previous example, you got only 40. So in the latter case, you as an investor get 5 million more from the same fund with the same performance. So the waterfall distribution structure actually matters, especially in the cases like that. Got it? Any questions? Don't hesitate to ask, to write, or I don't know, to call me by the phone.
It's clear for me.
Yes, but you are not alone. As far as I get, we have 21 participants today. Please don't hesitate to ask, okay? It's better to do it now rather than in October. Okay, now we should proceed. We have not that many time left, much time. So we have 2 more tasks, but they are different, and you will be mostly watching, however slightly calculating. So this task is on calculating these major multiples, right? So we have venture fund, which has a capital commitment of 150. It has called down only 130. In its 4th year of the investment, the fund has just exited one of the investments with the profit. It's not the total gross proceeds, it's just the profit. So let's say that was more than. But the profit will be distributed to investors. Let's consider the cost will stay in the fund and will be reinvested. In this case, it doesn't matter. The remaining part of the portfolio is 102. So the cost is in this part. Fee schedule, in this case, simple case, 0 management fee. Just simplify the calculations. And we have carried interest, but with deal-by-deal basis. So we had one deal. The deal was profitable, right? Part of that profit will be distributed to limited partners. Given all the numbers, you should calculate the paid-in capital multiple, DPI multiple, RVPI multiple, and TVPI multiple. Remember, TVPI is always DPI plus RVPI, so for you just actually have to calculate 3 of them. The most tricky should be DPI. I will give you 3 minutes just to try to do that. It's not that difficult. And we will continue. The tricky part here is account for deal-by-deal carried interest in this case. It's easy to understand that should it be whole fund basis, all the profits should be distributed, right, to the limited partners, and it will be easier. But in this case, it should be slightly adjusted. Please try to do what you just get. No problem. You will get the answer, but just try to guess. Are you on the same path which should be you on? I will start gradually showing you. Of course, we have to calculate GP's carried interest, in this case, deal by deal. Remember, every profitable deal assumes carried interest. So actually, from this profit of 60, general partner will get 12. This 12 will not go to limited partners in the form of distribution, right? So limited partners share in the profit will be only 48 instead of 60. Remember, NAV is 102, and our multiples will be like that. So actually, paid in kind is easier. 130 invested divided by the size of the fund, 150, which is committed, gives you 0.87. Distributed to paid in capital, in this case, will be 48, right? Your profits as investor, your part of the profits, divided by actual paid in capital, which is 130. And it gives you a multiple of 0.37. Residual value to paid in is 102 divided by, again, invested capital, 130, gives you 0.78. And you combine the latter two multiples to get the TVPI, which is 115. Did you get the same numbers?
Yeah.
Yes, those of you who actually have not got them, just try to look at that. If still something unclear, please don't hesitate to ask. Okay, I assume it's fine, and I continue. The last task for today, it's quite big, but it's for sure we should have enough time to cover that. It's venture capital fund benchmarking, again, public market.
Can you show a previous slide, please?
Yes, of course. Okay, okay. Sure. Sure. So again, I will try to cover that. Maybe I will help somehow. We have the fund size, which is obligation. Only part of that was fulfilled, i.e. 130 was actually called in form of cash. There was a realization of the profit, and the profit itself was 60. The cost stays in the NAV, which is 0.2 in this case. The most important thing here is to understand the situation that given the deal-by-deal waterfall, American style, more GP friendly, we should pay carried interest to general partner right after the deal, right after the profit was realized. And it should be split 80-20 immediately. And instead of limited partners getting all the 60, they get only 48. All the same, all the other cases, all the other numbers and logics stays the same. It's just one small caveat here, which should be taken into account, that investors will get less from profits. Can we continue?
I'm sorry, how do you receive 102? What is NAV?
NAV, that's okay. That's net asset value. That's the initial part of the exercise. So your portfolio, so
Okay.
you have invested something into the fund. There was some activity there. The general partner has something bought, something sold. In this case, he has cash on the account, right? And he has the remaining part of the portfolio, which is 102 in terms of valuations.
Now it's clear. Yes,
Yeah, so altogether, some cash on holding companies, stocks of non-public companies with valuation. Put it all together, you have 102 million unrealized.
yes,
And some cash to be split. Yeah. And given that it's deal by deal, the profit, which is to be sent to investors, should be adjusted at this step. Okay. If it's clear, let's move on. If still some questions, please ask. I will come back again.
Sorry, yes, I have one question also. So I'm getting a little bit confused with distinguishing between commitment and actual capital call. So could you please turn on the previous slide, please?
The task?
Yeah, the task. So could you please clarify a little bit? So what's the difference between capital commitment and however has called down only 130 million? So what's the difference? Is it because 130 in cash and 150 in like assets, or what's the difference? Because
that's very important thing. We have to cover that. I hope we cover that on the lecture, but thanks for asking. It's better to ask here. Okay, I will try to cover some basics again. Sorry, I will try to somehow cover that. So, do you see the desk, the board?
Yeah.
Okay. So look, what is the fund size? So we have the fund, and what is the fund? It's the legal documents, right? Itself. If you took it, it's the legal docs. According to these legal documents, all the investors who are investors into the fund, which is altogether limited partners, they are obliged to provide capital. Remember first two lectures, when general partner asks this money. So altogether, they are obliged to provide 150 million US dollars when GP will ask this money during the life of the fund. Actually, part of that, which is investment period, right? So this money might be called during the, I don't know, 5 years out of 10 years of fund's life. So something will be called down on year 1, something on year 2, something on year 3, something on year 4. That's the obligation. Nobody has invested this money at the day one. It's not hedge fund, it's not ETF. When you invest money at day one, and you get back all the money when you want. Private equity and venture capital, and actually private capital industry in general, works with mostly with fund structures. The fund is the set of legal documents according to which investors will be obliged to provide money in pieces, of course, in tranches. When general partner find the particular interesting target for investment and ask money to invest in it, and then manage this fund. So coming back to your question, what's the difference between 150 and 130? You should not compare them. You should just get the feeling that 130, it's the fulfillment of the obligation 150. It means that limited partners out of this 150 has already paid into the fund 130. So there is still 20 million left in form of obligation. If general partner will ask, they will be obliged to pay additional money into the fund. For instance, general partner will find another promising company to invest in, and he will say, look, I need this 20 million because I have another, I don't know, Facebook or Google, early stage stuff. I will invest, and you will have to pay. In this case, you will pay 150 into the fund out of 150, and general partner will not have any possibility to ask for more money in this particular fund. And what he will do, he will launch another fund with 150 limited partners commitment and 0 capital call. And he will start asking capital again. That's how it works. You launch funds every time when you cannot use your fund, previous fund, you launch the next one. Does it answer your question?
Yeah, thank you. It's like very understandable. And this amount cannot be extended. It means that if we have, for example, 150, then if we reach it, then we cannot extend it. We have to run to start a new fund, yeah? Or
the normal
there are
practice,
provisions.
the normal practice for general partners, actually, I say general partners for you to easily understand, but generally they are so-called sponsors. When you say Anderson Horowitz or Sequoia Capital, that's actually the brand names sponsor. Right? They launch new funds. And for each fund, they make the fund and they form new legal entity called General Partner XYZ, which will be running fund XYZ. For each next fund, the general partner as a legal entity with number and register will be different, but still you understand that that's the same house, right? So the practice is that once you have exhausted the fund or investment period has finished in particular fund, you as a sponsor launched a new fund and you attract new investors into this fund. And the strategy might be slightly different, etc. And you just continue doing that from fund to fund, from fund to fund. That's why they have fund 11, fund 15, fund 16, because the investment period has either finished or they have already exhausted the commitment. Sometimes it happens, especially in the latter several years. Some funds were very active. They actually start launching funds closer to each other. Consider that as a vehicle, as a mechanism of the investor's money transferred to the particular investments. So there is a middleman in here, right? And it's middleman in terms of the investment team and some legal structure which actually helps all this to work. Again, 130, that was cash. That was out of pockets from investors, out of investors' pockets. That it is in the fund. That's why the general partner had an ability to make investments, because to buy a particular stake in the company, you need cash, right? And actually, commitment, it helps you to negotiate. You come to the deal and say, look, let's do a term sheet. I have a commitment. I like your company. Let's do the term sheet. If I like it, you like it, we make a deal, we shake hands. I call money and we do deal. That's how it works. And they call money. Once they have a term sheet, they call money. And they make a deal itself. I hope it helps.
Yeah, thank you. It helped a lot.
Sure. Don't hesitate to ask. Okay. Now let's switch to the benchmarking against public benchmarks, and it's the task similar to the one we covered in the middle. So consider the situation that we have invested into venture VC fund. Simple situation. We have 3 dates. We have contributed once 50 million. We got the distribution from the fund in April of 2017. And as of the end of 2017, our net asset value, so actually our stake, valuation of our stake in the fund is 24. Right? So actually what we got 50 invested, 38 got back, and something left in the fund. The valuation of this, according to financial statements, which we receive as investor from general partner, as 24. And consider the question from your bosses. Look, asked they, was it better to invest into this fund, or was it better to invest into, I don't know, Russell small cap technology companies index, or something like that, Russell 2000? In the United States, particularly, that's the index of mid and small cap companies. And a good question, right? Good question. to ask yourself from time to time, was it better to be invested in a liquid fund or in liquid universe? And we have to answer this question based on three methods I just covered today, earlier on. Remember, LN, which is Lon Nichols private market equivalent, KSPME is Kaplan-Scholler PME, and direct alpha method, which shows you the outperformance by particular percentage points. Just go and we'll see that. First of all, up and left. Let's just simply calculate the IRR of our cash flows and NAV. So consider that final NAV is a cash flow, so our IRR, which is partially realized, partially unrealized, but the total IRR of investment into the fund is almost 15%. Now let's consider the situation that we could invest and divest from the particular index. So let's find the dollar value of our investment of same cash flows into this index. We have invested 50 million at day one. At this point in time, that would worth 50 million. At the time of the distribution, our investment has increased in value, right? By 16%. You have to multiply 50 by 116 divided by 100. But at the same time, you have to sell your ETF or your index to get right the same distribution, right? 38 million. And your asset value in this strategy would be 20 million exactly here. If you go to the latest date, your investment until this point would provide you with, it would increase even more, right? So it would increase by 28%. So your investment of 50 million would increase by 28%. But your distribution would also increase to this point in time, right? But by 10% only. So what you should do, you should accrue those performance using index values to both contributions and distributions for particular periods in time, and get the final so-called public market equivalent net asset value, or PME NAV, in terms of dollar values. It answers your questions. How much dollars would I get should I make the same amount investments into the index, out of the index, on the same date? It says you it will worth you 22.1 million, right? We talk about millions here. So what you do, you take this value instead of actual NAV from financial statements, which was 24, and calculate the same IRR. So actually you take the same cash flows, but different net asset value, and try to get the IRR. In this case, of course, the IRR will be lower. So Lon Nickel PME IRR will be 12.7, which is less than IRR which you calculated above, which means that according to this method, your venture fund has outperformed the public market equivalent. So we wouldn't be better off investing in ETF on the Russell 2000. We're still better off investing in this fund, if we believe in this valuation, right? 24. But we should believe that's the best estimate. Is it clear? I think let me cover two other angles of these equations so you will get it all together. I think it will be much easier to comprehend. We can do the same thing, but we can change the logic. If we don't care about IRRs, but we care about only absolute performance, we can calculate total value paid in multiple. In this case is 1.24. How I get it? I put the sum of 38 and 24, which is distribution plus residual value, and divided by paid in capital, which is 50. Right? So my multiple is more than 1. It means that the performance is positive, which corresponds to a positive IRR, right? But what I want to do now, I want to compound my cash flows into the future. just to calculate the future values of each cash flow. In the first case, my 50 million investment should be increased by 28%. My distribution should be increased by only 10%, right? 10%, I got it 128 divided by 116. It will give you only 20%, not 12. So I've got future value of my net cash flows. I take them instead of actual cash flows and use the same NAV and just calculate the multiple. And this multiple is 1.03. What I do, I just compare this multiple with 1. If it's more than 1, it means my fund has outperformed the index. If it's less than 1, it is underperformed. So in this case, again, we have outperformed the public market. Same conclusion, but just differently. And if we are asked still, okay, if you outperform, by how much in terms of IRR? And simply you can say from here, look, it's more or less 2% of something, right? If you just subtract one from another, you get 2.2. But as far as you remember, subtracting multi-year returns is not something very exact, right? So what we can do, we can just take the combination of those things, and we can calculate in terms of multiple, we can calculate IRR. Given the multiple is 103, we should get the small IRR, and this small IRR is 2% only. So this direct alpha method shows me that direct alpha is more than 0, which means there is an outperformance of 2% in terms of percentage points, in terms of IRR. So not 2.2, but 2%. All these numbers more or less exact. And we got the same conclusion from all the approaches here. They're very much similar. You just either adjust the final net asset value, or you use the same asset value, but you adjust the cash flows. And you calculate either IRR or the multiple itself. So basically that's it. Using different methods, you can get different conclusions. So you can answer that your performance was by 2%, or you can just state my fund still outperformed, or you can say, okay, in terms of IRR, should I be investing in the public market? I would get IRR of only, I don't know, 12.7%. By the way, compare this 12.7% with 28%, but which should be annualized. If you annualize that by 2 years, they will be quite close in this case, but still they will be different. So you should compare money-weighted return, which is IRR, with money-weighted returns. You cannot directly compare annualized return of index with IRRs. Both of them will be annualized, but they will be different. Keep that in mind if you don't remember that. IRR is money-weighted, depends not only on the timing, but on the amount of cash flows. Index returns doesn't depend on the amount of cash flows. It doesn't matter whether it was 50 million or 5 million investment. The return is always the same. Okay, guys, that's it for today. Please don't hesitate to ask questions. Actually, our time has concluded, but I'm ready to help you with some things here.
Could I please ask you to send us the presentations for the last 3 classes so we can just study a little bit more?
Yeah, I will do that. Actually, I already discussed that with your colleagues here. Here is my email. Actually, you can write it down. What is interesting, actually, what is important to me, I expect your group to put together your names and family names all together, and 2 columns in Excel, one with Gmail accounts and the other with Higher School of Economic accounts. When I say accounts, I mean emails. And I will use that to launch finally the Google Classroom. It will be much more efficient for you and for me to have this virtual class where you will have lectures, white papers, some tasks assigned to you, and etc. I used it last year. That was very helpful, and I encourage you just to give me this and then start using it. Google Classroom.
We already have that. Have you got the link to it?
I'm not sure. Maybe this is my email. Please send me the link if you have it.
Sure. I will. Thank you.
Thank you, Victor. Dear students, do you have any questions on this last task? First of all, just get the logic. You will try to do it by yourselves with numbers. You will get the feeling of numbers. But first, you should get the logic. I hope logic is clear. But if not, please ask. I will try to explain differently. Okay, what I suggest them to do, please send me the link to your file. As far as I get, it's still not completed. Your colleagues just maybe 30 minutes ago, no, 1 hour and a half ago, just looked in that and saw that not everybody of you did that. Please remind your colleagues to do that. And the faster you do that, the better for me and for you. So, and that was interesting stuff with May holidays. That was the reason why you are still not having the presentations. But this weekend I will send it to you. But for me, of course, to better it just to put it directly into Classroom. If there are no questions, then I suggest to finalize the seminar for today. Please let me know if you have them, questions. If not, then we should say goodbye to each other. Until next time. Okay, it was a pleasure. Don't hesitate to, that's the link. The problem with the link that I'm in the class, once I shut down the presentation, it will disappear. So it's not convenient for me to use it. Please, can you send it to my email? Can you see my email?
Yeah, we can. It's like your name and surname, yes.
Yeah. We see it. Yeah, I actually wrote it down already.
Okay, perfectly. Please send it. I hope that was helpful. To just a small introduction to you that we are covering like the fund logic by this seminar, and we are gradually moving down into the fund, and we'll be considering more aspects of particular investment into the companies. Of course, I'm not be talking about entrepreneurship and best markets, but the mechanics of investing, the conversion of notes into the stocks, the capitalization table, the different rounds of financing, all that stuff, and valuation method. That would be next in our lectures. And I highly encourage you to talk with your other colleagues who are not visiting the lectures and seminars that it's not a good idea. Of course, as far as I know, the lectures have been recorded, which is strange to me. I think that's a bad practice because some of you think it will be easy to listen to the lectures later on, but that's the problem. I'm studying this for 5 years already, and all my experience is saying that those who are trying to do it in the end usually are not successful. They have many questions not covered on time, and usually that's the problem. So I encourage you and other colleagues to at least visit partially the lectures, the seminars, and be ready to ask questions, whether you misunderstood or you just missed something. Just take that chance, because once we finish lectures and seminars, I will not be somebody to ask you to answer any questions. I will be the person who will be giving you exams and just marking them. Okay, lectures available for 2 weeks. Okay, that's a good practice, by the way. I think that's important for everybody to time their efforts, because if you just pass it all the way somewhere, it's like with debt in financial system. Okay, thank you for visiting. It was a pleasure. See you soon, and look forward for the link to this email. And you will get this weekend the lectures. Bye-bye. That was a pleasure.
Thank you. Goodbye.
Goodbye.